Hello everyone, welcome back. I'm Mayur Thaker. I'm an analyst and co-portfolio manager here at Zacks Investment Research. And this is a major update among many, but of course with a lot of information coming out this past week. I wanted to make sure everybody is up to speed on everything that happened just yesterday as well as overall over the past 2 weeks specifically. And so we're going to see a number of updates on the charts that you should hopefully be used to seeing, but within that context of a lot of additional information. So let's get started. We've got a lot to cover. So what happened over the past couple of weeks? So just yesterday, today's Thursday, March 23rd, just yesterday on Wednesday, the FOMC announced another 25 basis points increase to the Fed funds rate. That takes us to 5% now. That's basically the highest rate since 2007. These actions overall have basically inverted the yield curve by the most amount, by the greatest degree since in over 40 years. So it's been a pretty acute move, very, very aggressive, take by the Fed in reaction to inflation being also at 40-year highs. So the Fed has believed that they have a clear mandate since unemployment is very low and inflation is very high. The Fed has interpreted that as having a very clear-cut mandate to go ballistic on controlling inflation, and that's what they've exactly done, and they've taken that opportunity quite quickly. However, I think that we're actually reaching a point where the Fed is kind of thinking of the federal funds rate as the way to get inflation down, which is true. But the problem is that the Fed funds rate is like a giant hammer. And when you have a massive hammer and very small nails, you end up not only hitting those nails down, but you also damage other things that weren't broken in the first place. And so the Fed funds rate at 5% now, which is, again, the highest that we've seen since 2007. But more importantly, in terms of, how high we are, I believe that inverted yield curves are very, very dangerous territory. And the 10-year yield, for example, is a market interest rate that hasn't really agreed with the Fed's actions. Remember, all bonds, price in interest rate. All bonds price in inflation risk. All bonds price in growth risk. All bonds price in credit risk, and all the other factors and risks that go into bond valuation. And the market discounts all of that information and comes up with a final number, which is decided every single day. And the 10-year yield isn't anywhere close to being at 5%. Remember, this is a stark contrast to what we saw in the 70s. We'll take a look at that chart here. But I believe that the market does not want the Fed to be this high, because the market balances inflation risk with growth and arrives at a number that is, most accommodative to both sides of the equation. Inflation, bringing inflation under control without destroying growth. And with the 10-year yield at 3.5% and tips, by the way, this is an amazing, development. But over the past year, tips, which are supposed to do well in an inflationary environment, have been down almost 15%. So what does that tell you about what the market believes? The market views that this inflation that we're seeing in the CPI is in passing, and it is in the process of coming down significantly. And so I think that the Fed is starting to overdo this aggression here with rate hikes, because I don't think that the market really wants rates to be this high. Why do we know that? The 10-year yield, the tips, right? Two very big, very liquid markets where millions and millions of traders from all over the world get together and form price discovery based on all available information, including inflation. And so if the 10-year yield is saying rates should be at 3.5% over a 10-year duration, the overnight rate should be something lower than that. And so I think at 5%, which inverts the yield curve by the most in 40 years, the Fed is at this point getting to the area where things can start to break. And we just started to see that here. And so we can move on to the next point. Silicon Valley Bank and Signature Bank of New York both entered severe financial duress. They're unable to meet their obligations in terms of withdrawals from depositors, and so they go into receivership by the federal government. All depositors got bailed out, but this is the kinds of things that you start to see. Now we can debate this because obviously, in hindsight, there was massive failure in terms of risk management at both of these banks and others too, where they thought that they could just buy 10-year treasuries and no one would ever ask for their money back in big numbers, and so they were fine with sitting on massive unrealized losses, but they never hedged against interest rate risk. Even though rates were at zero, that was the lower bound. It was obvious that rates would eventually go back up at some point, because you can't go further lower than zero. I mean, unless if you think we're in Europe and we get negative interest rates, but that would be a silly gambit for a bank to be taking. So when they bought, these, 10-year treasuries and mortgage-backed securities, they should have bought some insurance as well, in the form of, for example, interest rate swaps that would hedge out interest rate risk, but they didn't do that. And now we see, these two banks, entering, seeing massive unrealized losses on their held to maturity securities, and are being forced to sell them at a loss and, lock in that loss in order to meet withdrawals. And other banks might be in a similar boat, maybe not as bad as Silicon Valley Bank, but other banks like U.S. Bank Corp and Bank of America, this is just my opinion. So of course, we definitely want to do your own due diligence as well. But, I think that U.S. Bank and Bank of America both are sitting on pretty large unrealized losses on their held to maturity portfolio. And, with rates at 5% now, this is strongly incentivizing people, everyone, to ditch the banks and go into treasuries. If you have a lot of money just sitting in the bank, you're basically, kissing away 5% risk-free if you were to buy a 3-month treasury bill. So that's what's going to happen now, I think, with 5% now, which is way higher than what the market wants to price fixed income, via the 10-year treasury yield. This is basically a giveaway by the Fed. And I know myself, I've already pulled out money from my bank, and I'm, holding a money market mutual fund now that pays, 4.6%. Because why shouldn't I, right? Banks don't really pay much in interest at all. Most, banks like Chase, Bank of America, Citi, and even the regional banks and smaller community banks, nobody really pays much of a deposit rate, even though the Fed funds rate is now at 5%. So there is a very wide gap between what the Fed is guaranteeing and what people are actually getting from their community banks or even large banks. So this is going to put additional stress on banks, in my view. So I think overall, I see inflation is coming down. We're going to look at a few charts like that. Inflation is very clearly coming down. And the only reason why it's still at 6% year over year is because a few items that go into the CPI are still very elevated, whereas other measures of inflation have basically round-tripped the entire surge during post-COVID. So inflation right now is at best uneven. And so when you look at the 6% CPI year-over-year rate of change, that's not indicative of all inflation. That's the average, right? And obviously the CPI is influenced by how certain things are weighted. But for example, gas prices are very much tame. Natural gas prices are down significantly. We'll see more charts like that. But a lot of, measures of inflation have come back significantly and have essentially reached 0% year over year, and in some cases negative year over year. So I think the Fed is starting to make a mistake here. I think they've gone too far in hiking rates, and I actually said this in a previous webinar. I think it was back in December. That was when I started to kind of caution this, is that when you start to hike significantly beyond the 10-year yield, then things start to break. And that's what history has shown. You can see from this chart right here, whenever the Fed funds rate exceeds the 10-year yield by a wide enough margin, that's when things start to break. And you can see that, whenever that inversion has occurred between the Fed funds rate and the 10-year yield, that has precipitated a recession. And this is probably by design too. I think the Fed knows this. I don't think they're stupid at all. I think they know exactly what they're doing. But I believe that they are operating under a, bring inflation down at all costs type of mentality. And part of that is not their fault, because their mandate is just two things. They don't have a growth mandate. They have only a dual mandate, which includes two things and only two things: price stability and maximum employment. So when they look at the unemployment rate sitting at historic lows and inflation sitting at historic highs, they think, well, we've got a lot of room to hike. And the problem with that thinking is that although they're following their mandate, so it's not their fault that they're simply following the rules that were set forth for them, they're not thinking in terms of the total cost to the economy. So, by getting inflation down at all costs, I think, they're kind of ignoring the part where the damage to the economy from recession exceeds, the value creation from bringing prices down. And that's what's happened basically every single time they have forced inversion. You can see that during, in 2000, the 10-year yield was already marching lower because there was recession building up here. And yet the Fed continued to insist on rate hikes up and through 2000. That was when the market last peaked and it entered recession at that point, and the Fed then had to cut, quite dramatically here. But by then, the damage was already done. The same thing happened in 2006, 2007, right before the great financial crash. Now, you can't blame everything on the Fed. I'm not saying that either. You can't just say that, everything breaks because of the Fed and everything is fine because of, for other reasons. No. There are problems in the economy that are outside of the Fed's control. But when the Fed tries to push the envelope a little too much to bring inflation down, I think they're doing this at all costs, meaning they're trying to get inflation down regardless of the cost to the economy. And that's because their main focus is just on employment, right? If they see that unemployment stays low, then they're like, okay, we don't really care about growth. We're just going to keep hiking until prices come down. And they look for that, natural balance between unemployment and price stability. But the real sort of balance they should be looking at is maximizing real GDP growth, I think. That's just my opinion. But again, we're kind of treading in very dangerous territory here with the Fed at, well above the 10-year Treasury yield now. Every single time this has happened, things have broken. And remember, the Fed funds rate is a gigantic hammer. It's not a very precise tool. So it affects all things. It kind of hits everything equally with equal force. And not everything needs to be hit down, right? We have, some things that have come down quite significantly in price, and other things remain elevated. So at best, we have uneven inflation. But you can see that even that sort of uneven inflation at the aggregate level, that number is coming down. You can see here, this is the chart that we've been looking at for many months now, a overlay of the CPI versus the ISM backlog index. And, remember, the CPI is a lagging indicator. So that's another major criticism I have of the Fed, is that these measures of inflation, be it CPI or PCE, these are lagging indicators. And you can see this clearly because the ISM backlog, which is not even a market, it's just an index, even that has a leading advantage. You can see here that the backlog peaked almost a year before the CPI peaked. This is about a 10-month advance notice here. And backlog started to come down as supply chains finally eased up here and was able to address the pent-up demand. You can see backlog started to ease quite dramatically, and CPI only eased almost 8 to 10 months later. So CPI is a very, very lagging indicator, and I think that I'm afraid that the Fed is formulating policy based on data that has already changed, and it's just taking a while for the numbers to come through into this data. And so since last August, if you've been following my webinars here, I've been saying that as the backlog eases, I expect the rate of change of the CPI to come down quite significantly. And you can see the backlog is now in contraction. So anything below 50 is contraction. So even if this bounces up a little bit, that doesn't mean much. We're still below 50, which means that it's contracting year over year. So I expect the CPI to come down quite significantly over the course of this year. And I think at some point before the end of 2023, this is going to be at 0%. I really believe that. So it's at 6% right now. I think we'll be at 0 at some point this year in 2023. And it won't stop there. It's going to go negative, because we need that mean reversion to happen in prices. So I think, inflation coming down is already underway. This is, something that moves in momentum. Once it starts to move, it won't stop. It's going to move in one way until it finally reaches some level of saturation. And so I see that, the CPI is naturally being solved right now. And that's, primarily attributable to supply chains, coming back. You can see the backlog is a function of production minus consumption, or production minus orders, I should say. So when backlog is high, that means the order rate significantly is outpacing the production rate. And so now that the number is coming down, dramatically, this means that production is covering the order rate quite easily right now. So that bodes very well for prices overall in the economy, and I think that's going to continue to come down. So again, I think the CPI and PCE both are operating with high latency, meaning it's a very lagging indicator. And so if the Fed is formulating policy on the fact that the CPI isn't coming down quick enough, unfortunately, I think that's looking at data that's almost 6 months stale. So 6 months from now, I think the CPI will be much lower than 6%. And so by hiking even further, I think we're getting to that point where other things that, are working fine start to break down. And that's what leads to recession. So you can see certain things, for example, I have selected 4, very important commodities. All 4 of these commodities are showing no signs of inflation at this point. You can see crude oil futures are down to $71 a barrel. It's actually below 70 now as of this recording. But you can see that number is pretty much in line with where we've been at for the last 15 years. You can see we were at this level back in 2007, and again in 2010, and again in 2015. This is not a, highly inflated number at all. Same thing with natural gas futures. This is actually at the low end of the range for the past 30 years. Wheat is back to where we were in the mid-2000s as well as in the mid-2010s. Again, there's really nothing to see here in many of these charts. Lumber, stole the headlines back when we had that hyperinflation of 2020, 2021, where lumber futures tripled in value, right? And everyone, was panicking that, home improvement projects were getting way too expensive because lumber was insanely expensive at Home Depot and Lowe's. You can see lumber is basically a round trip to that entire move up. We're basically at the same levels that we have been in, 2000, what is this, 2013, 2004, 1997. I mean, like, there's really nothing to see here anymore with regards to key commodity inflation. So this is going to seep into the economy in terms of consumer prices. It always operates at a lag. That's something that we all know. So at best, inflation is uneven. We see housing prices, rents, used cars, and electricity prices. These are some of the key items that remain very unaffordable right now, which is keeping CPI elevated, right? But others, like I just showed, are, back to normal. So, and this is just my opinion, but I think that the Fed funds rate is a weapon, but it's a one-size-fits-all weapon. It's a massive hammer that will eventually crush these inflated areas of the economy, but at tremendous collateral damage as well. And so that's why I think that the 10-year yield has not gotten to these levels, and that's why, this is the chart that shows basically why the Fed thinks it's okay to do this, right? The Fed thinks that they have a mandate to do it because unemployment is at historic lows at 3.6%. But again, that's a little bit misleading as well because, not only, even though this number is at lows here, labor force participation is still very, very low. So you can have low unemployment if a bunch of people simply exit the workforce, right? So unemployment is a little bit misleading right now. And I know the Fed, does track, the labor force participation ratio, and I'm sure they do. I don't think they're, I'm not saying that Jay Powell or anybody at the Fed is dumb at all. I think they're very smart. They know what they're doing. It's just that the mandate that they have been given it does not factor in collateral damage to the economy. They believe that they want to find an equilibrium between unemployment and inflation, even if it hurts real GDP growth and destroys value overall. And that's the point. That's the point that I feel like needs to change eventually. But that's a bigger question that only Congress can address here. But, what does all this imply for stocks, right? So we're all investors here, so we want to get to the core of this, which is, what does this mean for our portfolios? Well, I think that the market is still significantly overvalued, and I believe that it's getting to a point where risks are building. So I have a chart here that illustrates, where stocks were valued the last time we had the Fed funds rate this high. And this chart is a little bit old here because, we just got the update yesterday, so it'll take a day for ZRS to show it. But, we're basically at 5% right now. The last time we were at 5%, the S&P was at roughly a 15 multiple. You can see that. You can go back all the way to 2006. That was the last time during the last rate hike cycle that we were at this level. And if you look at what the PE multiple was at that time, it was 15 times. Today, we're at 18 times. So, I think that, we were much lower, in October, but we've rallied quite significantly off that low, despite the fact that earnings estimates continue to be slashed. So I think that this rally that we have seen off the lows in October is a bear market rally, in my view. So I think the risk is substantially to the downside here. You can see that, again, if you were to compare 2006 to now, in 2006, we at least had earnings growth, even though we're, entering recession. But even then, we still had about 5 to 6% earnings growth at the time. You can see this is a chart of the S&P earnings growth year over year, and we were right around 6 to 7% at that time. Look at where we are today at minus 2.7% year over year. This is forward earnings growth expectations, not historic, but forward. So right now, analysts expect year over year growth to be negative 2.7%. So this means that we're not only this means that the last time we had a 5%, rate, the Fed funds rate we're at a 15 multiple on higher growth. We had 6% earnings growth at that time, and the market was still valued at 15 times. Today, we have negative growth, and we were valued at 18 times. So, I just don't see a reason to be long the S&P 500 right now. Again, we see that the Fed is removing liquidity, right? The Fed is actively fighting this. I think the Fed really wants stocks to come down. They can't say this. They won't say it explicitly, but, they're removing liquidity. They are hiking rates aggressively. They're inverting the yield curve on purpose. They know that they're doing this. So I think that there is risk in the S&P 500. You can see for the first time in history, M2 is now negative year over year. And so they're committed to reversing this massive tick up in the money supply as a result of COVID stimulus. So this was a grand monetary experiment that the Fed is now, backtracking at a very, fast rate. And they really want to get this down back to trend growth here. So the Fed is very, very committed to removing liquidity from the economy. And with stocks at 18 times earnings, it really stands to be vulnerable. The other thing, too, is that the Treasury yield curve has started to steepen. This suggests the beginning of a recession. Remember, what happens? Inversion happens in advance of recessions. And then what happens when things really start to get crazy in the market? That's when reversion happens, meaning that's when steepening happens. So when it goes from inversion to then steepening, that's the time to get truly cautious, because that's when something is about to happen in the economy that accelerates markets to the downside. So inversion is sort of the quiet before the storm, and reversion is when the storm has arrived. So we saw a little bit of that this past 2 weeks, as Silicon Valley Bank and other banks started to enter duress, Credit Suisse as well. It's not yet, big enough to really register just yet, but that's something I would be keeping a very close watch on. So again, this is the 10-year yield. This is the 2-year yield minus the 10-year yield. Or actually, I got that reversed. The 10-year yield minus the 2-year yield. And it's currently at negative 0.49%. It used to be at 1%. So that's been cut in half. So the short end of the Treasury yield curve, yields have really dropped quite quickly, a lot faster than the 10-year yield has dropped, and that's what causes this steepening to occur. So if this steepening were to cross, zero, I would say that would be the catalyst. I think that would be when a catalyst is about to arrive that sends stocks materially lower. So I'd keep a very close eye on that. Meanwhile, in the economy, demand side indicators continue contraction. You can see, ISM, manufacturing new orders, that's in contraction. Durable goods orders, that's in contraction. Factory orders, that's in contraction. Not yet deep recessionary levels, but remember, these are coincident indicators at the end of the day. So you can see that this is where the economy is currently, and it's in contraction. Housing is showing signs of slowing. Again, this is what the Fed really wants to do. They're really trying to take, a massive hammer to the price of homes, because we saw home prices surge, in response to, all the trillions of dollars that the Fed, printed in QE as a result of the pandemic. And a lot of that money has, seeped into real estate, which has caused the biggest move up in real estate that we've seen in a generation. Really since, I haven't seen that since the last time we had hyperinflation back in the 70s. So the Fed, again, is getting very aggressive on that. They really want to bring this down. And remember, this is all things that contribute to the disappearing wealth effect, which ultimately brings stocks down as well. Unemployment, again, this lags the turn in the business cycle. So again, keep an eye on the unemployment rate. But again, you really want to remember that the unemployment rate is usually the last shoe to drop. This starts to move up slightly in advance of the recession. But the best way to kind of view this is to look at this and overlay it with, say, for example, the 5-year or even 3-year moving average. So whenever the unemployment rate crosses above either the 3-year or the 5-year moving average in the unemployment rate, that's usually a pretty good sign that the recession has arrived. And so I'd wait for that. It hasn't happened yet, but that's another thing to keep an eye on. This is another favorite chart of mine. This is the Chicago PMI. This measures the the production at factories located in the Rust Belt of the U.S., mostly the Midwest. And this correlates quite highly with S&P earnings growth. And you can see the Chicago PMI has been in deep contraction, really the worst since 2008, 2009. So this bodes very negatively for the market. I think that the S&P will most likely have a negative growth year on earnings. So again, this all contributes to reasons why I think I'm very, very cautious on the market right now. And you can see that, analysts are basically responding here. Earnings estimates have been marked down quite dramatically. And I think this is going to continue. I think this trend will continue with the Fed remaining this aggressive at 5% now, with the yield curve still inverted, with banks having difficulty meeting withdrawals from depositors, banks being forced to sell securities at a loss to fund those withdrawals. Something is brewing here. I hate to be a little unspecific sometimes, but these are not good trends to see. And especially when markets are priced at 18 times, I don't think that recession is the base case at all right now. At 18 times earnings, that to me says that the market is priced for the opposite. It's priced for a soft landing. It's priced for inflation coming down without, unemployment spiking. And I think that is a dangerous thing to have as the base case right now. I think that's what's priced in. So if we don't get that, then there is substantial risk to the downside. And every indicator that I'm seeing here is really pointing towards lower earnings, as we progress through 2023, increasing risk for certain parts of the economy, such as banking, which will inevitably have spillover effects for the rest of the economy. So even if the Fed backstops all depositors, net, this is a negative because we have banks going under and other banks being forced to sell at losses. This is going to hit bank earnings. And remember, banks are still a pretty big part of the S&P 500. So I see that this number will continue its march lower. So again, the primary takeaways here, let me just summarize everything that I've tried to say here. The Fed is hiking aggressively into a slowing economy, in which inflation is already coming down thanks to normalization of monetary policy away from ZIRP and QE, and massive easing supply chain constraints. Remember, loose monetary policy is not the only reason why we had inflation. It's also because factories couldn't find enough workers. Imagine all the for-hire signs that we've seen throughout storefronts. People were not able to find enough reliable workers because of the Great Resignation. Labor participation plummeted as a result of the lockdowns and the COVID scare. So there was massive labor shortages throughout the economy, which adds to supply chain pressures. And that's why we had the highest backlog we've seen in 40 years. So that all contributes to inflation. It's not just, the massive, cannonball of money that the Fed blew. It's also the fact that people resigned and factories were running well below capacity. So it's a combination of both of those that led to the highest inflation we've seen in 40 years. So, monetary policy is now, completely the opposite. And supply chains have reversed entirely, as we see from the backlog index. So, and the Fed is inverting the yield curve. I think they're getting a little too aggressive here. Banks and certain other entities may come under severe pressure. And the full extent of collateral damage to the economy of an aggressive Fed is still unknown. So we're looking at unknown waters here. We don't know what else will blow up with the Fed this aggressive. And the 10-year Treasury yield basically saying that, hold up, we don't think rates should be this high. So I think, as my personal opinion, the 10-year yield believes 3.5% is sufficient to balance inflation control without breaking growth. So I really think we should be listening to the market more often, but that's just me and my opinion. Meanwhile, estimate revisions for the S&P continue to trend negative. The S&P still trades at 18 times forward earnings. That's highly elevated relative to its negative growth, high Fed funds rate, and high likelihood of recession. So the takeaway here is to remain defensively positioned. I would own 3-month to 1-year treasuries, which offer just tremendous value right now at 4 to 5% risk-free, as well as the Zacks earnings certain proxy. Remember, this is our portfolio that we manage of very high quality, recession resistant, steady earnings compounders. I overall continue to expect pretty large downside to the market. I think $210 of earnings, which is a very modest drawdown, by the way. 210 of earnings this year is only about a 5% drop in earnings year over year, which is not a lot, right? So just a garden variety earnings recession with a garden variety recession multiple of 15, just very modest assumptions gets us to a very low number on the S&P 500, 3150, which is over 20% lower from today's levels. So, again, this is the reason why I think the risk reward is skewed to the downside, because with a very modest earnings and PE expectation, we see a pretty big deviation from today's levels. So I think the risk remains to the downside, because with today's valuation, I think, a soft landing is already priced in. So the only way I'd revise all of this, when would I admit that I'm wrong, right? We always have to check, place ourselves under check and make sure that we're not viewing things from, just one lens. So, I would revise this and admit that I was wrong if we see a reacceleration of earnings growth. Remember, earnings are the main thing that matter. We need to see earnings growth rebound quite strongly in Q1 as we get earnings reports coming out over the next month or so. And that needs to reaffirm that companies are well capitalized on their balance sheets and are seeing a return in growth. If we see that, then yes, then today's multiple could be justified. But with all of these things kind of building up, with inverted yield curve, with the Fed remaining aggressive more than what the market is currently telling us, with banks coming under pressure, with earnings already under negative revisions, with most companies coming out issuing guidance on much lower growth expectations, I just don't see that happening. But I would be more than happy to admit that I was wrong if we do see that. So I will, be sure to tell you about that, in the coming weeks and months as we get Q1 earnings coming in. So the capital allocation strategy so far, as of today's information right now, 1 year or less maturity treasuries. 1 year treasuries currently pay 4.3%. That's awesome. You can also buy a money market mutual fund, but I would be selective. I would look at the holdings of that fund and make sure that they only invest in treasuries or deposit funds directly with the Fed. For example, the Vanguard Treasury Money Market Fund, that's VUSXX, that one does that, and that one stays at $1. It never had any issues, for example, throughout 2008. So I'd make sure that whatever money market fund you select only owns short-dated treasuries, like 3-month treasuries or less, and or deposits directly with the Fed. So that's what the Vanguard, Treasury Money Market Fund does, VUSXX. SXX. And there are probably others like that as well. But I would make sure that, whatever money market fund you select checks off those two boxes. And then, combine that with the Zacks Earning Certain portfolio. So you position yourself for a low growth environment with a combination of recession resistant growth, which is the Zacks Earning Certain portfolio, and income, which is short dated treasuries. So growth and income, recession resistant growth and income. That would be a great strategy for the foreseeable future. And so this is the kind of companies that we own in the Zacks Earning Certain proxy. So again, if you'd like more information about this portfolio, I'd love to kind of, discuss that with you in greater detail. But these are the types of companies we own. Very high quality companies, battle-tested companies that have lived through recessions in the past and have managed recessions beautifully, almost flawlessly, as you can see in these earnings growth charts over the past 20 years or so. So again, hope you found this helpful. Again, I'd love to hear from you if you have any questions or feedback. If you are a ZRS client, please send us an email at zrs@zacks.com or advisortoolsclient@zat@zacks.com. All right, thanks everyone, and I will definitely be looking forward to keeping you posted in the next several weeks and months as things unfold further. Talk to you soon. Bye.